All right. Welcome everyone. Very interesting session. We have a lot of audience with us. Dharmesh sir is there with us to help us guide these markets. So Nifty just hit an all-time high. A lot of people are scared right now. क्या चल रहा है? Overvalued है नहीं है? क्या है scene कैसा है? So in this scenario, a very important question becomes: what are some of the steps which investors should take to safeguard their portfolios? So could you help us with that?
Yeah. First of all, thank you very much for giving this opportunity. So firstly, as you correctly mentioned, the currently dilemma with the investor, if we see valuation, it's, trading at a all-time high. If we see the Nifty valuation premium, then it's trading at very high level is compared to its own historical average. And mind you that, even within a Nifty bank, also forming a very major part of the index, and that itself has not done that great. If we see particularly banking space, then it has relatively underperformed the broader market, and valuation there, at least when we see as compared to the historical average, still looks reasonable. So if we even remove that, the banking part, which is major part of the index, and if you see X of that, then the valuation is even more higher for X of the banking space. So just to give a number, the premium to its own historical average, X of BFSI space, if we see, then it's almost 44% premium, almost, as compared to 9% premium that it used to historically trade. So that shows, the what kind of a, the valuation at which, Indian markets are trading at, and whatever, technical fundamental indicator we see, that gives a little comfort at this point in time. But having said that, if we see, the macro wise, I think we are in the best position. I think nothing wrong with that. We have, the extremely strong flow support as well from the domestic as well. Uh, there is a strong flow support as well. So here, the that conflict, right? On the one side, the economy is doing very well, flow is very strong, and on the other hand, the valuation is, giving little bit uncomfortness as to when to enter the market, and what to do. So in such kind of a scenario, what we think, probably, the following asset allocation kind of a approach, what investor can do over here, and like hybrid fund, yeah, well placed to do this kind of a thing, the moving allocation between the equity, debt, gold, as and when the one asset class become attractive over the other, and depending upon the where the current valuation and how the fund managers see particular thing, they decide on the particular allocation as to how much he wanted to be in equity, how much he wanted to be in debt, how much he wanted to be in gold. So that gives at least the some starting point for the investor who is very in dilemma and what to do when the market is every day crossing all time highs, and the on the one hand the valuation is not giving that much comfort. So I think the following asset allocation kind of a model, and the having a hybrid fund which well accommodated to do this kind of a thing for an investor, I think it's a right strategy to start with. I think you are on mute, Lisa.
All right.
Well,
So
we
so
not
sorry. Yeah.
getting your voice.
Right.
Huh.
Right. So, sir, I think recently there have also been some changes which are beneficial for investors actually, in
Yeah.
terms of taxation of funds of funds. So, could you
Right.
tell us a little bit about it, sir?
Yeah, so as per the the recent budget, what the changes has been brought into that, there is one category of government is identified as a specified mutual fund. So in this kind of a mutual fund, like fund of fund, where you have more than less than 65% into the debt oriented mutual fund, then it qualifies within that specified mutual fund definition, and where the tax applicability will be like that. If you are holding that mutual fund for more than 24 months, then the tax applicable will be 12.5%, as against earlier, which used to be as per the slab rate, like a marginal rate that as per the slab the investor has to pay as against that. Now it has changed to 12.5% for the more than 24 months for long-term capital gain. And if it is a below 24 months, anyway, it will be like a short-term capital gain at marginal tax rate. It will be get tax rate. So that is the difference when we see pure debt mutual fund scheme and where this specified mutual fund scheme that is there. So as far as yeah, so that is the broad change that the recent budget has brought into.
Right, absolutely. So let's talk about particularly this asset allocation fund that we are talking about today. So there are a lot of market cycles,
Right.
right? We see there are downtrends, there are sideways. A lot of time market goes sideways, and then we recently since COVID we have been seeing a massive bull run, which is currently also going on.
Yeah.
Nobody knows how long that will last or what will the next cycle look like. How does our asset allocation fund navigate through these market cycles?
Yeah, as you rightly said, the various asset class return is based on, the market cycle. For example, in the expansionary phase, equity market do well. If there is the contraction phase, then probably the debt will give you a better return, and there will be some point in time where the gold probably give a better return. So the return between the various asset class, the move in cycle, and when we the shift allocation between these asset class between equity, debt, gold, I think it gives the better investment return experiences that what we believe. But having said that, for individual investor, it becomes very difficult, to when to, increase equity, decrease equity, when to increase debt, when to decrease debt, when to put in gold. So in such kind of a scenario, the having this kind of asset allocation fund, plays an important role, which, tries to capture, the various asset class return experience within the one umbrella, and where the investor have does not have to worry about that the taxation part as well, because as an individual, if you do a switch between equity, debt and gold, then probably you end up paying with tax also. That will be and post tax return, if you see, that might not give you a better return experience. So here within this asset allocator fund kind of a fund, that things taken care of very efficiently. uh, and there are various, the research paper also states that the more than 90% of the alpha that you generate from the portfolio depends on your how you allocate among various asset class. So that becomes a very important part of the overall, the investment return perspective as well. Now, if you see, the particularly now, and also see, particularly this asset allocator fund, if I say it's run based on, the our in-house allocation model, which is bit counter-cyclical in nature as well. So, Warren Buffett says, you have to be fearful when others are greedy, and you have to be greedy when others are fearful. So this model exactly, tries to capture those things perfectly. And when we see the market valuation is at a high, it gives little margin of safety. The equity allocation will be lower. When we see the market valuation is attractive, we try to increase the equity allocation. Just to give the some perspective, the historically from the recent example, because that might many of you also will be remembering also during the COVID low 2020, the model, the equity allocation was went as high as almost 85%. And just before the Russia-Ukraine war that has been going on, the model equity, the actual investment equity level was as low as below 20% as well. So this is the broader range with which we operate within the fund. Yeah.
Right. Absolutely, sir. Sir, this is, as per my understanding, this is now we are in a hybrid space since this is an asset allocation. So of course, we are talking about multiple instruments here. So how do
Yeah.
we position ourselves within this hybrid space?
Yeah, so if you see currently, as far as the our portfolio positioning perspective as well, we if you see the last month end as well, we equity allocation is near about 35%, 6 to 7% in gold, and balance is in the debt schemes. So that shows, the where the current pay based on the valuation, we are at near to the the lower end of the range of the market. That is how we are currently positioned in this fund.
Right, right. All right, sir. So my next question is, we have, I think, recently increased our exposure. Just a second, I'm sorry, that echoed, I think. So I think we've recently increased our exposure in equity and reduced the exposure in gold. So
Yeah.
what's the logic behind this, sir?
Yeah, right. So there were two things, that has led to this changes in the portfolio. First, view on the gold. So earlier we used to having very high percentage of gold, and when there was expectation now started also getting built into that the Fed will going to cut rate, and that is how the gold has also reacted positively to that event. That is what also earlier our thesis when we built the the gold portfolio, that the once the Fed will start cutting the rate, or there will be the expectation started getting built into the probability the people will assign to the rate cut will be increasing, the gold will react positively to that event. So that is exactly what we have thought of has been played out, and we thought the now incrementally the margin of safety that we are seeing in the gold is not that high, and so as a prudent measure we thought to trim down some exposure on into the gold, and we shifted now that allocation to equity. Now I come to that part, you will ask question that the valuation is high, the market has also done well, why you have increased equity exposure despite that. So now, so here again, if you see the recent changes in the taxes, the budget that has the government has made, we need to have at least the 35% between the non-debt scheme. So now that leaves the option with either equity or gold. Now gold, as fundamentally we are not becoming that positive, and we thought to reduce some exposure, so that then the next choice remain to increase the exposure in equity, so that the we continue to get the benefit of the taxation. Now within equity also, what we have done, we have not gone ahead and bought schemes or the sector which has the done extremely well, or in very high euphoria phase or something like that. We have gone ahead and increased the exposure broadly into the two schemes, that is one is a banking and financial fund, another one is the energy fund. Now banking and financial, as initially also I mentioned, there at least valuation is still reasonable relative to its own historical, and sector has also underperformed quite a bit, so that gives some kind of a comfort. And anyway we were underweight, if you see within the equity portfolio bucket, we were still underweight on the that banking space. So we it was come as a very good spot to then start increasing weightage onto the bank. On the other hand, we also increased exposure to the energy fund. Now that fund, obviously, we have recently launched, and we are trying to run that fund more, on the conservative side as well. And that space also now of late has seen a bit of correction. So, incrementally we thought, to increase the exposure in that fund as well. So, however, we have increase the equity, but that, with very prudent measure, we try to select the scheme or sector, where there is, the margin of safety is there.
Absolutely, sir. Sir, my final question has to be, we discussed a lot about the fund, the asset allocation fund. Who is this fund for? So who is the ideal? So people are here to find out if this fund is ideal for them. I want to ask you, who have you made this fund for? Who are the ideal investor profile that you are looking for this fund?
See, basically, this kind of a fund will be suitable for investor with slightly, the lesser risk appetite, and at the same time want to have, the exposure to the equity as well. And as this fund, is very counter-cyclical in nature, it will have a lower equity exposure when the valuation is high, higher equity exposure when the valuation is low and margin of safety is high. So in terms of the risk-adjusted return, if I have to see, then, it gives a superior return experience on the risk-adjusted basis. So this is the suitable for the investor who have a slightly less risk appetite and at the same time want to enjoy some upside from the equity market also. So I think that very much suited for those kind of investor.
Absolutely. Well, this was very insightful, sir. Thank you so much for your time for
Yeah.
helping us with this fund. I'm sure a lot of people are gonna like it. Thank you so much for
Yeah.
your time, and thank you
Yeah.
everyone for joining us.
Yeah. Thank you.
Please note that mutual fund investments are subject to market risks. Read all scheme-related documents carefully.